So again, thank you so much for that. What I'd like to do is introduce our next set of speakers from ING. They're going to talk about Index Universal Life as well. And in the spirit of these new products, I think it's important for us to look at a few different angles. And ING brings a lot to the table in terms of concept. It's one thing to start to understand how Index Universal Life works. It's another thing to know how to relate that to your clients and talk about different concepts that you can bring out there. So what I'd like to do is introduce Colin England to Colin up here and from ING and tell us a little bit about their concepts.
Thank you. Thanks, bud. How are we all doing this morning? You know, I think we should always kick a meeting off with a little mortality humor. What do you think about that? What did one casket say to the other casket? Is that you coughing? I figure I can only go up from there, right? All right, so who sells IUL in this room? Quite a few. Some people don't sell IUL. Curious about IUL? I'm going to talk about IUL this morning. I'm going to make it understandable, hopefully, so you'll be able to go out and talk to your clients about IUL. The idea is, I'm looking for a presentation here, the future is now for IUL. I mean, I've been talking about IUL for about 3 years. ING came into the market real heavy with the product I'm going to talk about this morning about 2.5 years ago. And basically, when I first went out and talked about IUL, everybody just kind of looked and their eyes roll back in their head. Well, those same people now are selling IUL. They're asking for IUL. If you're not selling IUL right now, you're missing the boat. You know, this right now, IUL reminds me of how variable was in the 90s. Anybody selling variable in the 90s in this room? No? Nobody? Remember those days when you go out and talk to your client about the rule of 72 and they could double their money like by the next weekend? Remember those days? The good old days? Well, I used to sell variable in Los Angeles at that time. Anybody's been to Los Angeles here? Los Angeles has a lot of tough neighborhoods, don't they? Do you know how you're working in a tough neighborhood when you're wholesaling IUL or wholesaling VUL? Is when the broker sits down with you and his asset allocation is small cap, mid cap, and hub cap. You know you're in a tough neighborhood. It gets better, believe me. There we go. Do we got a clicker here somewhere? How does this one work? Hit that? There we go. All right, I'm going to assume that you've all taken the Evelyn Wood speed reading course. No, that doesn't work. Sir? Oh. I can't go. How do you go forward on this? Oh, here we go. All right, I'm going to assume you all took the Evelyn Wood speed reading course here. Anybody have any questions on those slides? No? All right. What is IUL? It's very simple. It's really a middle ground between universal life and variable universal life. IUL is a universal life product, right? It's part of the general assets of the insurance company. You don't have to be a security license to sell it. It's a general account product. Traditional UL has a guarantee, right? Typically, it's like 3%. The new products coming out now are like 2%. Variable universal life is the other side of the coin, right? There's no guarantees. You got separate accounts. You got the whole upside of the market, but you got the whole downside of the market, right? IUL hits the middle ground. It's a perfect product for the consumer out there in today's market. Where are consumers' mindset right now? Fear, isn't it? We're in a recession, but we've got more cash on the sidelines now than we've had in the history of our country, right? These people are just sitting there. I just seen a full-page ad in the Arizona Republic the other morning for American Express. We're promoting an 80 basis point money market. I bet you the phones are ringing off the hook. After tax, what is that, 40 basis points? People are sitting in fear right now. They're just sitting in cash. The few people that are in variable, they get up every morning and they don't like market volatility. Some guy in Britain or France says something, the market drops 200 points. The next day it's up 200 points. People right now are in fear. IUL is the perfect product to get those people off the fence. There we go. So how does a UL work if you understand universal life? Very simple. What you have there is you have the guarantee, right? Typically it's 3 or 2% on a product. Then you have the crediting rate above that, and then you have the profit. Now typically a UL is going to go out and get rates similar to what the interest rates out in the marketplace. So what are you getting in ULs right now? 4.5%, something like that? So that's how a UL works. How does an IUL work? There we go. IUL, same thing, only you have a much smaller guarantee. For example, in the ING product, it's 1%. So what you have left over is you have what's called your option budget. Okay? What we do with that is every month we go out and we buy options on the particular indexes that are in that product. And there's going to be a cap or a participation rate on there. And then we've got our profit margin above that. So if you understand UL, you should understand IUL. It's very simple. The only difference is the margin above the guarantee is invested in going out and buying options every month. So if you're buying this product monthly, guess what? You create a new bucket every month, right? You got a brand new bucket every month based on where the index ended that month. All right, little history lesson. How many people in here go back to career? Anybody come up in the career system? Whole life? You understand whole life products? If you understand the insurance industry, we keep going back in the same cycles all the time. If you sold whole life back 20, 30 years ago, it was a very expensive product, wasn't it? You had to overfund the product to get the guarantees in it. So what happened in the 1980s? What's going on here? Oh, let's go up here. What happened in the 1980s was we got universal life, right? Remember those high interest rates? You can get out there. The thing was, people were actually going into their whole life contracts at that time, and they were making loans against the policies at 5, 6, 7%, going out in money markets for 14%. It was great arbitrage. So the insurance companies came up with a product that was tied to current interest rates called universal life. Does anybody remember the big concept that was selling in the universal life days? Anybody remember vanishing premium? It became vanishing agent for all these people that sold it. But the reality was, what was the idea behind it? Put as little as possible in the insurance contract, right? Don't mix the living benefit with the death benefit. Just pay as, get a quick 10 pay and be done with your death benefit. So what happened in the 1990s? We got VUL, right? What was that? Cycled back, an overfunded sale, right? You want to get money into that contract. You want to use the living benefits of a life insurance contract. So we cycled back. The challenge with VUL was it became a product that people had a hard time understanding and managing, right? You had 70, 80 sub-accounts. How many people want to have that kind of relationship with their policy? How many of you guys want to go out, you guys and gals want to go out every year and manage their money for them? Anybody want to do that? Anybody want to sign up for that? It became a very high intensive product on the back end. What kind of relationship do people want to have with their insurance policy? Do they get real excited talking about it? Do they have it displayed on their wall at home? No, do they? They want to put it in the drawer and forget about it, right? They don't want to deal with it ever again. VUL was a very time-intensive policy. So what happened after VUL? What's been selling in the product market the last 10 years? Guaranteed UL. What is that? We cycle back to cheap as possible. We don't want a living benefit, right? Just get as cheap as possible for your life insurance. Don't worry about the other part. So guess what? 10 years later, we're cycling back again. And we got IUL. See what's going on in society. People right now realize they got to start saving money. And I think you're going to see people getting back again to the idea that we need living benefits in an insurance contract. So why? Very simple. I just talked about this. People want to participate in equity markets. They're scared. They want the upside potential, but they want that downside protection. It's a very simple concept. That's where people are mentally right now. Okay, this is a very simple slide here. If you look at the years they take here, I have a hard time seeing here. You take 1995 out to 2009. We're basically comparing we have a basic product. This is a basic S&P annual point-to-point product, 11.5 cap. You can see in that 15 years, the index did better. But I'm not trying to tell you the index is going to do better long-term than variable or the market. Because if markets, we've had a 10-year lost decade. I mean, we could have a great 10 years coming up. Typically, you'll do better in the markets. The idea I want to show you in here, which is interesting, is look at 2001 and 2002. You got a couple big negatives there, don't you? What do you think your average client would have done there? They would have got out of the market, wouldn't they have? We all know you have to stay in the market to make any money in the market. The beautiful thing about index products is it keeps you in the market because you got a 1% on those years, right? That client's going to stay in the market to get the future upside. That's the real beauty of the guarantees and index product. It keeps them doing what they should be doing. And that's what I want to show you there. All right, how big is the market? Well, IUL passed VUL this last year in sales. And the latest LIMRA statistics, IUL was at 22% market share. That means 1/5 of the sales are IUL sales right now. That's doubled in the last year and a half, and I fully expect that to double in the next couple of years. So if you're not selling IUL, that's fine, but you better learn about it because you're going to run into it. Your clients are going to ask you about it. A competitor's going to have it out there. You need to learn about IUL for no other reason than to fend off competitors because the product is out there. How come looking at me now? What's going on here? I think we lost our... There we go. All right, let's talk about why the market's going to continue to grow. Fear of unknown tax rates. How many people in this room thinks taxes are going up in the future? Anybody? Everybody does, huh? Anybody doesn't think they're going up in the future? Let me tell you why they're going up in the future. Who runs our country? Politicians, right? Does anybody know what the definition of a politician is? What does poly mean? Many. What are ticks? They're bloodsuckers. Many bloodsuckers in Washington. Insatiable appetite for taxation. That's not going away. I don't care what party it is. So the reality is people know taxes are going up. They know they need to find a tax hedge. Life insurance is a great product for that. How about retirement planning needs? You got the aging baby boomers, right? You got people that need to put money away. You know, it's a funny thing. When you look at other products being sold, they got sexy things. What do we sell as an industry for retirement planning? A three-legged stool. Isn't that what we talk about all the time? That's not very exciting, is it? And in fact, that three-legged stool is down to one leg, isn't it? When you look at it. Social Security, who knows what's going to happen with that? Retirement plans, nobody's got defined benefit retirement plans anymore. It's really up to the client to become self-responsible. That's what this product can do for them. How about changing market needs? Anybody see the no-lapse guarantee products going up in price? Have you seen that? Have you seen some of your products disappear? You're going to continue to see that. The insurance companies can't afford to support these products any longer. The industry's shifting again. I'm going to show you a no-lapse product a little bit later that we just came out with. It's kind of where the products are moving, kind of a hybrid approach. But you see all these trends going on, and again, this is why IUL is the product of the future. Okay, let's talk about some moving parts in IUL products so you kind of understand how they work. First of all, let's talk about indexes. You're going to have a multiple of indexes in these IUL products as companies continue to come into the market. If you look at a first-generation product was basically an S&P index, annual point-to-point, typically 11, 12% cap. That's typically what you see for a first-generation product. What you're seeing now is you're seeing a lot of companies coming in with multiple indexes, different indexes. My fear is you're going to have companies coming out with 20, 30 indexes. Guess what? Your client's going to have to pick indexes every year. You're going to be right back you were in variable again. They're going to be asking you to come out, will you help me select the indexes I want? So you're going to see more and more indexes coming on board. It's going to get more and more complicated. But I'm going to show you a way to compare products and understand products no matter what products come out to market. How about guarantees? Guarantees are very important. Typically in an index product, you got a 0 or a 1% guarantee. That's typically what you have. You also got to look at the guarantees in the product. Steve was talking a little bit about the actual contractual guarantees, because that's what your client's buying. Everybody's delivered an insurance policy in this room, right? What are those mortality rates in the front of the policy you deliver to your clients? That's the guaranteed rates of insurance. It's not what you show on those illustrations. All right? So you got to know the guarantees. All caps and participation rates are not guaranteed. There's a guarantee in the contract. Those are the current costs that we have. I know we love to sell by illustrations, but does everybody in this room realize that every illustration you sell is absolutely, positively not going to happen? Do you know that? Every one of them. I don't care what company you sell. So you got to understand the guarantees in these contracts. Cap and participation rates. Every product will have either a cap or a participation rate. You know, right now most of them are caps because most are still based on S&P chassis. But you're going to have a cap or a participation, and you're going to have a point-to-point period. Most are still annual point-to-points. Our product happens to be a 5-year point-to-point. I'll talk about some of the differences when I talk about the product. But you will see different cap rates. And I'm looking at me again. All right. Let's talk about illustrative rates. I'm going to talk about how to do a comparison on that in a second. How about loans? If people want to get the living benefits out of these products, they're going to take loans, right? They want to get access to those cash values later on. There's a couple of different ways they can do it. Most companies have what's called a traditional loan. How does that work? With ING, it's 75 basis points through 10 years. After year 10, you get what's called a wash loan. That means the money comes out of the index. It comes over here, part of the general account. We credit to and charge to. It's no longer getting index credits at that time, okay? There's a couple other loans out there that you'll see. One, you'll see a variable loan. I don't know if anybody's ever looked at variable loans. Some of the companies have that. How a variable loan is different is the money comes over here to an account that's based on the Moody's index, and then the money still remains in the index. So if you come over to this Moody's account, let's say it's 3% right now, and you're getting 6% on your money over here in the index, you're actually making positive arbitrage. The downside of a variable loan is if the Moody's index goes way up, if we have high interest rates, guess what? You can get way underwater with that, okay? We've got one other loan we have on our Plus product. It's called a select loan. Some people call it a participating loan. How that works basically is the money, again, goes over to an account. At ING, we charge 6%, but the money remains totally in the index. So again, if your index is doing 7, 8%, you're making money on your money. The beauty of this is at 6%, you know what your worst case scenario is. You get a 1% guarantee, right? So 5% would be the worst case scenario, the cost of that loan. So you know what your worst case scenario in that scenario is. So those are different ways you can get loans out, you'll see. How about fees and charges? Again, Steve talked a little bit about this. You need to understand the fees and charges. What's nice about ING is our index chassis is totally on our UL chassis. So we don't have any additional fees because it's an index product. Same chassis, same cost as our UL. So when you break that out, it looks the same. In fact, you know, actuarial spend a lot of time with this, putting these together. Anybody like actuaries in this room? Huh? Do you know what an actuary uses for birth control? Their personalities. All right, we get a little action there. All right. Let's talk about the ING product and what sets it apart. And you're going to see a lot of products in the future, and everybody can come up and talk about why they're different. But let me just give you a little spin on what we do. All right, first of all, we have multiple indexes. And again, this is changing. You're seeing a lot more companies with multiple indexes now. And this is the second, third generation products. You're not going to see too many standalone S&P products anymore. What we have is we have the S&P. We've got the Hang Seng, which is the Chinese index based out of Hong Kong. And we have the Euro Stoxx index. Okay, so we have 3 indexes. We got a 5-year point-to-point. And I'll talk a little bit about 5-year versus 1 year in a few minutes, but a lot of people think, well, 5 years is a long ways to wait. But I'll talk about how that works. There's no current cap on this product. So you're not capped at all, but we do have a participation rate of 70%. So why would you want a participation rate versus a cap? I think you see a cap rate a lot in guaranteed products, and I see it's seen a lot in S&P products because there's not that much of an upside. But if you have a product that has a Hang Seng, and I'll show you some of the numbers on the Hang Seng, you want to participate in that. You don't want to be capped at an emerging market that can get you a lot of potential return in a given year. Okay, but why should, you know, big deal. Why should we consider a global approach? Anybody in here, everybody's got money invested somewhere, right? Has everybody in this room got a little bit of money? Does anybody got all their money just in the S&P? Probably not, right? You diversify it a little bit. We all know a global approach works, and here's why. If you took the S&P from 92 out to 2009, and you took those 3 indexes I just talked about, and the U.S. market has been the largest market during that time period, what percentage do you think the U.S. market came in number 1 of those 3 indexes in that time period? 0, and that's a little conservative, but 9%. So if you just had an S&P product, you're giving up 91% of the potential. Now, the S&P does real great. It comes in second to 71% of the time. It's a nice, steady, you know, 8, 9, 10% type product. But look at the Hang Seng. It's either first or last. You either get a real bang for your buck or it's terrible, one or the other. But you need that kind of potential for your client to grow their money long term. And if you can take out the downside of an emerging market like the Hang Seng and give them 1% as a worst case scenario, that makes it real comfortable for them to get in something like China. All right, here's the GDP of the 3 indexes. The nice thing is they don't correlate. When we had that real down market 4 or 5 years ago, they did correlate. But generally, you don't see any correlation in these markets. You can see China, what it's done. It's been growing at 9% the last 30 years. In fact, I just seen in the paper they said they're going to have to lower their rate this year because they're growing. They're having some challenges. They say we might only grow at 7.5%, 8% this year. That's still 3, 4 times the U.S. growth rate. But again, that's the type of market your client needs to get opportunities to go with long term. All right. So then it comes down to how are we going to pick these indexes? We're right back to what we started before, right? Does your client really want to sit down and figure out, is the Hang Seng going to do better? Is the Euro Stoxx going to do better? How about the S&P? They don't want to figure that out, do they? And you don't want to figure it out for them. So what we're going to do is we're going to pick them for them with hindsight. So how does that work? First of all, the first 4 years you get 1% return, right? Because it's a 5-year point-to-point. So year 1, 2, 3, and 4, you get 1%. In year 5, we're going to look back at the 3 indexes. We're going to give you 75 of the best, 25 of the second best. We're going to throw out the worst index. So you don't have to worry. Your client doesn't have to worry about what market's going to do better. You know, they can take that policy and put it away, which is what they want to do. So we're going to do it all for them. It's all on automatic pilot. Again, there's no cap in the product. We multiply that by the participation rate of 70%, and then we take back the 4% we gave you on the guarantees. And that gets credited into your account every 5 years. To show you how that works, you got this piece here. If you want to take out of this, we turned around, take out this piece that says, harness the power of hindsight. And this has the indexes, and this goes from December to December, and these are 5-year blocks. So obviously, let's look at 1992, for example. You would have bought that in what, 87? This is something you bought in 87. It's coming due. So in 1992, we would have gave you 75% of the Hang Seng, right, at 141, 25% of the S&P, and we'd have thrown out the Euro stocks in that year. That means we would have put 81.99 into the account at the end of year 5. So it's as simple as that. That's how it works. And remember, people usually buy these monthly. People are usually putting away money monthly. So you're creating a bucket every month, right? So guess what? At the end of 5 years, what do you have? You have 60 buckets. Then one is coming due every month after that. So it's really only the first 5 years that you have that 5-year window with the 1%. So this is very simply how we do it. And again, we do it all for them. Yeah? Yep. Yeah, whatever one has done the best during that 5-year period. I think we do the actual percentage. Any other questions on this? Yeah?
Participation rate change.
Yes, it can. But the beauty of a 5-year, think of this versus a 1-year, is that you lock in the participation rate. So if right now you're saying to me 70% seems a bit high, you lock that 70% in for that 5-year window. Now when it comes to the end of that 5-year, you're going to get whatever it is. Our guaranteed participation is 15. That's why you got to look at the contracts. We have no intention of going to 15, but that's what your client's buying. They're buying the actual guaranteed participation rate. We're currently offering 70. The same with any product with a cap. It might be 12, but their guarantee might be 2. Same idea, but you do lock it in for that 5 years.
Is a 5-year option
It's less expensive. 5 years less expensive. It's you lock in the guarantee. The other thing about 5-year option is think of it this way. If everybody understands diversification, right? If you bought these monthly, if you bought an annual point-to-point, at the end of 12 months, you got 12 buckets, right? You're just on a month-to-month. At the end of a 5-year, you got 60 buckets. If you're trying to hit a goal out there, do you think you got a better chance with 60 buckets or 12 buckets? If you understand diversification, you got a better option with 60 buckets. That's why long-term the performance on this product, because how we do it, outperforms most of the other products in the market. Where did I put that? All right. All right, so now the question becomes, I told you a little bit about the ING product. How do you compare these products? I mean, you can call Steve and he can all do it for you. I understand that. But if you want to understand yourself, how do I compare all these products in the market? There's going to be more and more products. How do I figure them all out? What's the difference and how do I compare them? I'm going to give you a way to do that, which I think will be something you'll learn about how products are put together. First of all, let me show you typically how they're done. There's 3 common ways the products are usually compared. You got either equal rates, in other words, run them all at the same rate. You've got the max rate, whatever the rate the insurance company will let you illustrate to the max. And you got what I call historical percentiles. Let's look at each method. If you look at the equal rate, this was used a lot in variable days because what you do is you put the money in the S&P. Basically, the fee was about the same with all the contracts. Then you'd be able to see which contract was more expensive if you ran them all at the same rate and see who had the most cash. That's great in those days, but the trouble with index doing that is you have to have identical products. So you have to have the identical cap, identical floor, participation index, index period, and you're not going to find that. They're all different. They're all going to continue to be all different. So you can't run them all at 7% and say it's equal because it's not equal. Now you can run them all at a lower rate, but you've got to adjust for the product, and I'll show you how to do that. The other way is to use the max illustrative rate. How does that work? Well, basically, every carrier, like Steve was talking, goes back and kind of cherry picks a period and says, well, these were our rates, and we're going to go look back in a certain period, right? And we're going to say, well, based on that, you can run it at 8% or 7.5%, whatever the number is they allow you to. The trouble is you don't know where they come up with that number, and they can pretty much choose any time period they want to choose. So that usually doesn't work. So how about historical percentiles? Let me show you how that works. What we've done is we took every period from January of 1980 to June of 2011. So we bought the index every day during that period. All right? And then what we're going to do is we're going to run them forward on 20-year periods. So you got about 4,000 different periods going forward. Okay? And what we're doing is we're taking our current cap, our current floor, our participation, and we're running it against the historical averages on the index. So it's actual real-world numbers for the last 30 years. And we did this with our product, and we did with every other product in the industry that's currently selling out there. This shows the risk-reward of different indexes, and it's not predictive of the future. We don't know what any of these indexes are going to do in the future. All we can do is look and say, what have they done historically based on the current cap, participation, guarantees, et cetera. We have an index. Brokers Alliance can run these for you. We can get you the index if you want it, but we have an actual index. All you need to do is put in the current information on that particular product, their cap rate, their guarantee, their participation rate, whatever it is, and you can run any period you want to run, and it will tell you what that product has historically done. Any product. So if you know that for any product you're competing with, you put it in there, and it will tell you, hey, it's done 6.5 the last 20 years. And if they're showing at 9%, you can go back to that client and say, don't you think these numbers are a little skewed here? What we did for you, we got another piece I want you to take out of your folder. It looks like this. We put these all together for you in one piece, because when I try to push someone to a calculator, guess what? They never get there, right? So what we did is we took our calculator and we ran all the companies that are currently in there, and we gave you their percentiles. So if you look at the first chart up top, we got 50, 80th, and 100th percentile. What does that mean? For example, the 100th percentile, that means over the last 30 years, that product has done that 100% of the time or better. Okay? 80% or better, 50% or better. So you can see what these products have actually done historically. And that's why, again, you can't compare apples to oranges. You really have to look at that. If you look at the middle one, you see we're running them all at 6.5 there. Here's why you can't run them all at the same rate. Because you can see there's a couple companies that haven't done 6.5 the last 30 years. There's a few companies like ours that have done well above 6.5. So if you want to run them all at 6.5, let's say, you just got to make an accounting for the other companies and run them lower than 6.5, so you're comparing apples to apples. If you want to be very conservative and run your index at 6.5, 7, just make sure you're also being very conservative on the other companies. So this is a great piece to use. Whether you sell ING or not, this is a great piece to be able to look and say, okay, how's that company doing? Now, this gets updated every 6 months, so as new companies come aboard, as they change their caps and participation rates, it will get built into it. The calculator's updated already, but this piece gets updated every 6 months. So then you'll have a new one that comes out and shows you that information. Any questions on how this works? Okay. All right. Hey. So again, why do we look so much better here? I mean, we're looking at 8.18, 100th percentile. It's noticeably better than most of the competition. So why is that? Very simple. Again, global diversifications. Some areas like China are growing much faster than other parts of the world. We're going to pick them for you. You know, this is an idea that nobody else is doing. So, I mean, we're going to pick the indexes for you. You don't have to worry about asset allocation. Some other companies will allocate it for you, but then you're stuck with whatever that allocation is with that index. We're going to pick the winners for you. And again, we talked about 5-year versus 1 year. The 5-year point-to-point has a higher returnability. It just takes out some of the long-term volatility in the product. All right, let's look at some markets to sell this product in. First of all, you got Retirement Extra. This is nothing more than an overfunded VUL policy, or a IUL policy, right? We used to do it in the VUL world. In other words, you're max funding it to the 7702 limits. Later on, you're pulling money out for retirement. Very simple concept. We got a great presentation around it, but it's a very, very simple concept. I'm sure you've all done it before. You all got different titles for it. Executive bonus. I'm going to talk about executive bonus in a few minutes when I talk about our solar idea, which is kind of neat. Premium finance. Anybody in this room do premium finance? Okay. This is a great product for premium finance because it gets great long-term results. So if you got an exit strategy, this is going to give you a much better option on your extra strategy because you're going to have more cash out there. So if you're looking at premium finance, take a look at this product. Okay, first thing I want to talk about is I want to talk about where the guaranteed world has gone for index products. We just came out with a brand new index product, and it's kind of a hybrid because on the guaranteed world, what would you sell there? You'd sell that UL product, right? That real cheap UL on a guaranteed sale. On a pure accumulation sale, you'd sell something like the global product I just showed you. What we did with this product is we found kind of a middle ground. And I think that's what you're going to see with a lot of the guaranteed products coming out now because they're going to be more expensive and they're not going to be that cheap, zero cash value type design anymore. So how would you sell this product? Well, how you would sell it is you'd get the cheapest UL product. So let's say right now you're going to sell whatever the face amount is this. You're going to sell this product. You'd find the cheapest product you could. Now, our product's not probably the cheapest. I'm comparing it against our product. But you'd find the cheapest UL product out there. You're going to run their numbers against here, and you're going to see what our guarantee is versus them, and then look at the cash values. So what we did here is we took our GDB2 product, which is our guaranteed UL product, and you can see we're running at the UL rates. So you got the guarantee to 121, right? If you put the same premium into our IUL product, the guarantee goes down to 101. So you don't have quite as long a guarantee, but that's still beyond life expectancy for most of your clients, right? Most of your clients would be comfortable with 101 probably. But look at the cash value difference. Year 20, you got $175,000 versus 91. At age 100, you got $2 million of cash value. You've given your clients a lot more options. Maybe they need money for retirement. Maybe they want to pay the premiums with it. Maybe you want to turn that client up to another policy maybe down the road. Maybe there's some new policies in the market that they need to be looking at. If you're selling them a lot of the UL product, which has been sold the last 10 years, guess what? That's the last policy you're ever going to sell those people because there's nothing to replace. So again, it's just a different way to think about it. We're still giving them guarantees in the life expectancy range, but we're giving them a lot more options with cash value. So let's look at a 45-year-old as an example here. What we're doing here is we're going to run the same premium that gets a 121 guarantee for both products. Okay? So what you have now is you got an extra premium of $14,000 for the IUL product, right? But look at the difference here in cash value. You've got over 11% rate of return you'd have to get to turn that difference in premium into the cash value difference in 20 years. If you took a 28% tax bracket, I think that is, you need over a 15% return. So, I mean, your client's going to pay $14,000 more, and look what they're getting. And this is run at 4.25. So I'm running at the same rate as the UL. I don't know what the percentile would be on that, probably 120% or something, but we're running a rate that I think everybody would find very reasonable for an IUL product. So it's a very compelling thing to go out and talk to your client about. And guess what? The targets are higher on this product than just about any UL out there. And you got an ability to go back in later on and maybe talk to this client about moving to a different policy if it makes sense down the road. Let's look at a 55-year-old. There we go. Same idea. We paid $51,000 more in premium. But again, the return to make that premium into whatever the cash value difference is in year 20 is about 7%. After tax, it's almost 10%. 65-year-old, same story. Now we got a $40,000 difference in premium. We got you got 12%, 17% after tax. So if your client's looking for more value, maybe this is a story you should talk to them about. And again, I think you're going to see a lot of the IULs moving to this chassis. Again, for the company, they're charging more for the death benefit, which they want to do. You know, it's more cost effective for the insurance company, and I think it's a better deal for the client. So this is our brand new IUL guaranteed death benefit. So if you're in the guaranteed death benefit market and you're selling it, take a look at this when you look at your next guaranteed sale and run it through here. Do one where you're paying the same premium like the first one I showed you, and do one where you're showing the guarantee to 121 on this one. Go out to your client and ask them, would you sooner have a guarantee past life expectancy and 3-4 times the cash value, or do you want a product that has no cash value at year 80? You have a guaranteed death benefit, but what do you really want? All right, let's look at solar. Solar is a brand new idea we came out with about a year ago. It stands for self-owned life and retirement insurance arrangement. basically, what is it? It's a cell phone policy. It's really a progression from deferred comp. Anybody work in the deferred comp arena in this room? A few people? Deferred comp has got a lot more complicated. Before I say that, though, I want to make sure I got the right audience here. I was at a meeting the other day. I was talking about 419A and 412B, and somebody yelled bingo. So does everybody understand when I'm talking 409A and stuff here? Okay. 409A is rules have become very difficult in deferred comp, and a lot of small companies and they're all looking for different options. So we came up with solar, which is really an easy way to work in this market. And the idea, again, is to tax the seed and not the crop, right? That's the whole life insurance idea. You pay the premium after tax. Would you sooner pay the taxes today on what you earn and not that big bundle of money later on, or would you sooner pay on that big bundle of money later on? We all know we're going to be in higher tax brackets. So the idea is to pay on the seed and not the crop. And then, of course, you can never save enough money. I think we all know that. All right, there's 4 uses of the solar program. You've got the arrangement for the key employee. That's more like a 162 arrangement. You've got the S-Corp, LLC, LLP owner, small business owner. You've got IRA distributions. And then you've got IRA distributions once they've up in the RMD area. So we got some neat ways to use this product. Okay, let's look first at the key employee. Right now, we're in a tough economic time, but when the economy does get better, I mean, there's so many people underemployed right now and unemployed, there's going to be a lot of people looking for opportunities. So how is a company going to keep their key people in line? How are they going to keep the key people to make that company go? Well, what happens is most of them put in what's called a 162 bonus. Very simply, a 162 bonus, if you're a key person of mine, I'm going to give you, let's say Mr. O'Neill there, I'm going to give you an extra $50,000 because you're just a great guy. You like that? I thought you would. But anyway, you've got to pay tax on that. I get the currently deducted as a company, but you're in a 30% tax bracket, so you owe $15,000 to the government, all right? Either I got to gross up the bonus, somebody has to come up with the money for this idea, all right? So what we did here is we wanted to find a way to cover the additional cost with this solar program. So what we do here is we're going to have a bonus here of $10,000 for 20 years. The employee's in a 35% tax bracket. He's going to retire at 65. He's going to retire retirement income for 25 years. That's the scenario here, right? We're going to use the global product, the Global Plus product. We're going to assume 8.18, which is the 100th percentile. Premium of $10,000 for 20 years. We're going to use the select loans. Remember I told you about a select loan? We take the money, we're going to charge 6%, but all the money remains in the index. I talked about that a little bit earlier. So we're going to use that loan to pay the tax. So your client's not going to have to pay anything out of pocket for this. That's where we're going to find the money for this sale. Initial face amount of $265,000. We're going to start with an option B increasing, and we're going to cut it to an option A when we start taking the money out. It's the most effective way to do it. What we got here is we got about $1.2 million in retirement for this individual, and we start with a $268,000 death benefit. This is the page I like, though, and these pages all come with the solar program. It shows you the actual corporation, the company. They're paying $250,000. They get to deduct $85,000, so their total out of pocket is $165,000. For the employee, they're getting $250,000. They're taxable at $87,500, but there's no cost to them. They've already financed that taxability within the policy, so they don't have to come out of pocket with anything. They're still paying the tax, but they don't have to write a check. We know there's 2 very difficult things to do in this business, right? What's the most difficult? Prospect, right? Find the people we sit down and talk to. What's the second hardest thing? Finding the money to pay the premium, isn't it? Everybody loves insurance. They just don't want to pay for it, right? Here you found the money to take care of the scenario. You just finance it within the policy. We've taken that objection off the table. How about business owners? What are business owners most concerned with? Themselves, aren't they? Are we going to survive? You know, what's in it for me, right? That's what business owners are most concerned with. Most traditional business solutions aren't effective for them. So they want something flexible and freedom. And that's what's nice about these plans. They're very flexible. If you can't make the premium payment in year 2 or 3, or you have to make less of a payment, you can. Your numbers are going to change, but you're not locked into any kind of a plan where you have to pay money into it every year. So let's look at the small business owner. Same idea, 50-year-old preferred non-smoker, 40% tax bracket, $100,000 for 15 years, you're going to retire at 70, income for 20 years, option B switching to option A. Again, we're using the Global Plus product, again, a crediting rate of 8.18, which is the 100th percentile. Same idea here, but this guy's going to get $5 million in retirement income and about $1.8 million in death benefit. And again, look at really the middle page is the important one because they're in the same tax bracket. He's getting $1.5 million. He's going to pay the tax right out of pocket when he's getting that $1.5 million of $600,000. So there's no cost to him at all. He's funding it right out of the insurance policy. And you can see, again, there's the distributions down the road on that. So it's a great way if you got small business owners to go talk to them. You know, they all need these types of plans. They all need to do some of this planning. But the objection always is, I don't have the money to pay for this right now. You just self-finance it right within the contract, and everything stays in the index. So if you're getting historical rates, you're making positive arbitrage. Obviously, you can have negative arbitrage if it's under 6%. But again, you know what your worst-case scenario is, 5%. That's the worst you'd ever have to pay. How about IRA business? Anybody have any IRAs? People with IRAs in this room? No? Well, it's a big market, about $4.7 trillion. Distributions are taxable. You don't want to die with an IRA. You know, it's just a bad vehicle to die with or get money out later on. Right? It's a bad vehicle. But how about if we could use the Global Plus product to rescue some of these IRAs? Put some money in your pocket. Let me show you how that works. Again, we got a male 50 here, 35% tax bracket. Again, a minimum to have option B to switching to option A, 8.18, 100 percentile. He's got an IRA balance of $500,000. He's going to take separate and equal IRA distributions for 10 years. That's 72T. He's got to do that for 10 years. After 10 years, he can do anything he wants with it as soon as he meets the 72T rules. But since he's under 59.5, he's under 72T. Then at age 60, he's going to take the balance, and then he's going to take policy distributions from 70 to age 95. Let's look at, oh, there we go. Did I go the wrong way? What happened here? $2 million he's pulling out, and he's got a death benefit starting at $743 that's tax-free right away if he dies. Now, that wouldn't happen with the IRA, right? That was all taxable. Now he's got a tax-free benefit here. He's moved into a Roth IRA type container. You remember the Roth IRA idea that was out, and everybody thought everybody was going to move their money to Roth IRAs, but it didn't happen. Why is that? Because nobody wanted to pay the tax. You can do that here and pay the tax internally because you're moving to a Roth IRA type environment when you don't have any minimum premium requirements or anything like, or minimum contribution requirements, but it's really a Roth IRA type environment. Again, there's no employee here, but you can see again that he's taken $624,000. He's got $218,000 of taxes. He's just going to loan that right out of the policy. So he's moved his IRA, which is in a very tough tax environment for death or living, to a Roth IRA type environment without having to come out of anything out of pocket. Let's look at the second sheet here. This just shows you the sheet. It shows you the money going in. There's the cumulative loan. You get a cumulative loan on this. What's nice about this is if you're doing something like an executive benefit sale, let's say you got a group of people, you're putting on a bonus plan, 10 people, let's say. You don't have to have any administration with this plan. All you got to do is get an in-force illustration run, and it's going to show you the cumulative loan. It's going to show you the cumulative loan and the cumulative interest. So if you had a special person that you want to stick a carrot in front of, you could set something up with them and say, hey, in 5 years, Jim, if you hit your sales goal, I'm going to go back and pay your loan. And then you see the IRRs really jump on this thing. So this is all the administration you need on this. You don't need anybody doing anything more than running an in-force every year to see what's the loan balance and what's the interest balance on these things. So that's what you're going to see on this type of a plan. Okay, one last sales idea here. And this is using basically RMDs. Here's a client in the early 60s or 70s. They're going to be coming up on RMDs pretty soon, right? They're going to have to take required minimum distributions. They have an IRA. They don't need to live on this IRA. They want to pass it to the next generation as effectively as possible. And obviously, a life insurance vehicle will do that for them. There's an income and estate tax impact. And again, they want to pass this in the most economical way. He's 65, preferred non-smoker. Again, he doesn't need the IRA for retirement. He's going to use the Global Plus product. Again, he's going to 8.18, which is the 100th percentile. The current IRA balance is $1 million. So what we're doing here is we're going to pull out the money over 5 years. You can see the premiums coming out. That's the whole IRA coming out. What we're trying to do here is buy the maximum death benefit. So you can see year one, he has over $2 million of death benefit. So if he were to die in that year, you've just passed $2 million tax-free. He would have died with the IRA, you wouldn't have nearly that. He only had $1 million IRA after taxes. He's lucky if he's got half of that. So you put this person in a much better situation. And again, it cost him nothing out of pocket. He's paying any taxability from this IRA right out of the policy. And again, you can see the death benefit fluctuates a little bit because there's a loan on it, but you can see in the later years you get out to $3, $4, $5 million of death benefit. Again, I think the real beauty of this product, of the solar idea, is you're finding the dollars to pay the premium. That's the biggest objection you're going to get. Any questions I can answer about IUL, ING, solar? Anybody got any questions?